Okay, let's dive right in. We're about to explore the hidden battlefield where your wealth is won or lost, and it's all inside your own head. This is your brain on money. Sound familiar? That sinking feeling in your stomach when you panic sell just before the price shoots back up? Or that stubborn voice telling you to just hold on a little longer to a stock that's in free fall? Yeah, we've all been there.
But here's the thing, and this is really important. It's probably not because you're bad at math or a terrible strategist. It's more like a glitch, a feature in our brain's original programming that just isn't built for the modern world of finance.
So today, we're going to pull back the curtain on these glitches. We're going to give them their real name, cognitive biases. Think of them as these hidden scripts that are quietly running in the background, sometimes sabotaging your best-laid plans.
So what even is a cognitive bias? Well, imagine it's a mental shortcut. Our brains are lazy. They love shortcuts to make decisions faster. But when it comes to something as complex as investing, these shortcuts often lead us right off a cliff, causing us to make the same kinds of mistakes over and over again.
All right, let's kick things off with a big one, loss aversion. Just picture a set of scales in your mind, but they're totally unbalanced. That's kind of how our brain weighs gains and losses. And here's the science to prove it. Research shows that the pain of losing, say, $1,000 feels way more intense than the pleasure of gaining that same $1,000. This is why we do irrational things, like selling our winners way too early just to lock in a small gain, while we cling to our losers for dear life just to avoid the pain of admitting we made a mistake.
Okay, on to bias number 2, and you'll see how these start to stack up. It's called anchoring. And it's exactly what it sounds like. Our brain drops an anchor on the very first number it sees and then has a really hard time moving away from it.
You know how this works? Maybe you anchor onto a stock's all-time high price from 2 years ago. You see it's trading much lower now and you think, wow, what a bargain. It's got to get back there. But that anchor, that old price, might have absolutely nothing to do with the company's reality today. We end up making decisions based on old news instead of what's happening right now.
Now, for a bias that, let's be honest, can feel pretty good in the moment, but it is incredibly dangerous. I'm talking about overconfidence. It's that simple, powerful belief that we're just a little bit smarter, a little bit better at predicting the future than everyone else.
And the results? They're not pretty. Overconfidence makes us trade way too much, which just racks up fees and eats into our profits. It convinces us to put all our eggs in one or two baskets because we're so sure we found the next big thing. And worst of all, it makes us completely ignore any information that goes against what we already believe.
Next up is a social force that is just incredibly powerful. Herd behavior. You know, we're social animals. We're wired to feel safe in a crowd. But in the financial markets, following the herd can be a recipe for disaster.
This is all driven by the fear of missing out. Yep, good old FOMO. We see everyone else jumping on a hot stock, and we get this itch. We feel like we have to get in, not because we did the research, but because we're terrified of being the only one left on the sidelines. This is the psychological engine that fuels massive market bubbles and the spectacular crashes that always follow.
And our final bias for today might be the sneakiest of them all. It's called confirmation bias. See, our brain does not like being wrong, so it actively goes out and looks for evidence that proves we were right all along. It's like putting on glasses that filter out anything you don't want to see.
So let's say you're excited about a company. You'll find yourself clicking on every positive news story, every glowing analyst report, while your eyes just kind of glaze over and scroll right past any of the negative stuff. It makes it almost impossible to change your mind, even when the facts are screaming at you to run for the hills.
Okay, I know that was a lot of doom and gloom about how our brains are wired to fail, but here's the good news, and it's a game changer. We are not stuck like this. We can actually train our brains, we can rewire our mindset to be better with money.
So how do we do that? Well, one way is to think about it as a 3-phase program. Step 1 is just awareness. You have to start noticing when you feel that tug of greed or that jolt of fear. Step 2 is reprogramming. This is where you consciously decide to replace that knee-jerk emotional reaction with a calm, logical plan. And finally, reinforcement. You just practice over and over until the new, calm response becomes your default setting.
And a really effective tool for this reprogramming is mindfulness. It's all about creating a little bit of space between what happens in the market and how you react to it. It's about finding the power in the pause. That's where logic gets a chance to catch up to emotion.
So really, when you boil it all down, what are we talking about? We're talking about discipline. Like this quote says, it's about not letting your emotions run the show. Discipline is the bridge that gets you from having a good plan to actually getting good results.
And hey, this isn't just some feel-good idea. The data actually backs it up. This chart shows research that found a really clear connection. Traders who practice mindfulness reported much higher levels of trading discipline than those who didn't. It's a real technique that builds that mental muscle you need to stay the course.
So let's bring it all together. What's the one thing you should walk away with today? How do you master your own inner market? It's this. Winning at this game isn't just about spreadsheets and PE ratios. It is just as much a psychological sport. You have to understand your own mind just as well as you understand the market itself.
And so I'll leave you with this question to chew on. After hearing about these 5 biases, loss aversion, anchoring, overconfidence, herd behavior, and confirmation bias, which one do you think is your biggest blind spot? Because just knowing the answer to that, well, that's the first step to beating it.